You're about to join Niels Kostrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Alan Dunne and I, Niels Kostrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. Alan, wonderful to be back with you this week, a week that turned out a little bit different than most people expected when it comes to credit ratings and Apple earnings. How are you doing?
I'm good, yeah. It's pretty miserable here in Dublin, actually. We've had the wettest July on record, and it's definitely carried into August. So from a summer perspective, it's a pretty stop-start. But as you say, a very interesting week in markets and a big shift in sentiment, as you say, as we've gone through the week.
Yeah, we'll dive into that in a second. Yeah, I concur with the wet sentiment for July. Looking at the weather up here in northern part of Europe where I am at the moment, it has also been the wettest July on record, which is very interesting because that's obviously not what people have experienced in the southern part of Europe. So maybe the northern part will be the new south, so to speak. All right, well, as we normally do before we dive into your sort of global macro picture, which we will in a second, I was just wondering, I mean, we've got a lot of good topics lined up, but just more generally speaking, is there anything other than maybe the global macro stuff we're going to talk about that kind of has caught your radar since we last spoke a few weeks ago?
Well, I mean, we'll touch on it a bit more, but obviously from an equity market perspective, it was just interesting how, after the run-up, we saw a number of strategists turn bullish. About a week ago, I just saw Mike Wilson, who has been Morgan Stanley. He's generally been on the kind of the pessimistic side about earnings, but he seemed to throw the towel in a little bit in terms of the bearish case. And then a strategist at Oppenheimer Asset Management came out with a target of 4,900 for the S&P 500. So just as we hit that point of maximum bullishness, that the market turned down and we had a negative week. So it's just interesting how the market does that to you every time, that it brings you along and then encourages people to get more bullish. And then just at that point, we get a big change in sentiment. But we'll talk about that.
We will talk about that. It kind of reminds me of an interview I did quite a while ago. I've had this guest on a couple of times. It's a bit controversial. He's a financial astrologer. And so the comments I've kind of gotten is that either people think it's fantastic, it's the best things, ever, or it's completely mumbo jumbo. They don't believe a word of it. But what's been very interesting, not that I follow his work very closely and I don't subscribe to it, but I see some headlines from him and I remember the conversations I've had with him. And he has for a very long time been incredibly bullish on equities, throwing out numbers like 7,500 on the S&P at a time when it was down in like 2,000. And so I agree with you. I think there is, we know this for sure, that these so-called experts and strategists that come out with these forecasts, very often they change them right at the wrong time. But I am curious about this particular guy who's been bullish for a number of years, whether actually we will have a big breakout to the upside and things might take off. But let's talk about that a little bit more, because as we normally do when you and I talk, we do talk about sort of big picture global macro before we jump into other topics. And of course, it was a week, as I mentioned earlier, where there's been a few interesting things. Of course, yesterday we had July's unemployment report that came out a little bit softer maybe. It came out at 187,000 new jobs in non-farm payrolls. Expected was 200,000 as far as I recall. There was also a small downward revision in the prior months of about a 50K or so. But then you had hourly earnings that remained pretty solid. And I think the question that I see in the news is a little bit, is the Fed going to change its narrative from whether to raise rates further, or maybe it has to be how long do rates need to stay this high? If we just focus on that before jumping into the other big event of the week, do you have any thoughts on that?
The market seemed to see it as a bit of a weak number, which, obviously the dollar was a bit weaker in immediate aftermath, and obviously bonds had a big rebound yesterday. So it wasn't dramatically weaker. You obviously had the back revision, but equally, as you say, the earnings number was above expectations, and unemployment was back down to 3.5%. So I saw it as a bit of a nothing number, not particularly bullish or bearish, and certainly still consistent with the idea that the labour market is very tight. Obviously, 3.5% unemployment rate and earnings still growing pretty solidly. So, if you were looking for a slowdown, there was probably a little bit of a hint there to give you some encouragement. But yeah, I didn't think it was a really massively market moving number.
No. Another event, which of course on the surface seemed to be bigger, but net probably didn't move the market that much in the last couple of days, is of course what happened earlier in the week. And that is when we heard from Fitch that they weren't that impressed with what Janet Yellen and Jerome Powell are up to. And they downgraded the US credit rating from to AA plus from AAA. How do you see this play out, so to speak?
Yeah, I mean, I think most people were a bit skeptical, and a bit bemused with the timing. Yeah, I mean, you can accept their case. And their case was largely around, I think it was more of a response to the debate around the debt ceiling and all of that, and governance, as they say, as opposed to, the trajectory for debt to GDP levels in the US. Obviously, we've had, high inflation in the US, so that's kind of helped keep the debt to GDP level kind of in check. So it was kind of, it's kind of hard to understand what's prompted it now. I think what they're saying, you couldn't disagree with anything they're saying, but it's a bit surprising, the timing. I guess from a market perspective, obviously we did see a reaction, but it seemed to be more of a wake-up call to markets that there are risks out there. And as we say, sentiment had got very bullish, so it just seemed to be the trigger for people to presumably probably take back some risk. In itself, obviously, I wouldn't have seen it as being hugely significant. We did obviously have a downgrade, back in 2011, and you did see something similar in terms of a knee-jerk sell-off in equities, but eventually things recovered. So, yeah, I mean, it seemed to be more of a catalyst for kind of some profit taking. But fundamentally, yeah, I think people are kind of questioning, where is this coming from now?
Yeah, no, I did notice also, I think Janet Yellen came out and said she was, puzzled, in light of the economic strength that you see in the US. I mean, on the other hand, you could, of course, argue, you mentioned it yourself, that we have this debt to GDP ratio, which is kind of a measure of solvency, I guess. And we know that has ballooned since the 2008 financial crisis, and it soared even well above 100% during the pandemic. And according to St. Louis Federal Reserve, the debt to GDP ratio currently stands at about 120%. And to put that in perspective, that ratio was somewhere between 35% and 65% prior to 2008. So maybe, I mean, again, timing, you could argue, but, there is a little bit of...
I mean, there is a concern there. I mean, the economists look at two numbers on this. I think 20% of that debt is held by government agencies. So there's another number that if you adjust for that, it's about 100%. Now, it's 100%. It's a big enough number. It kind of hasn't got worse, I would have said, in the last year. But, I think the big thing is what's coming in the next decade. And, in terms of Medicare, Medicaid, all of that spending, and as the demographics change. So certainly it is a potential risk down the road. And the question is then, how will that be financed? Or will this trigger rising yields? But, it's kind of been a bit of a surprise that we haven't had higher 10-year yields, obviously extremely inverted curve. So it did seem like that the move was going to be the trigger for a sustained move up. But then again, yesterday, a rebound in bonds just when it looked like we were starting to see a breakout. So, I mean, I don't think anybody could be too surprised if bonds went up to 5% or so, you'd still have an inverted yield curve.
Yeah. No, very true, very true. Yeah, and you did note that of course we have seen this about 12 years ago as well, also in August for that, interestingly enough. And then you and I sort of exchanged emails because I was asking you, well, how did this had any impact on performance? You looked it up. You said, well, yeah, there was a little bit of a negative month, et cetera, et cetera. But At least for the industry, because when I look at the numbers that we produce at the firm I work for, it wasn't as bad as what you suggested. But you did say it's interesting because the trend followers in general certainly had a challenging period starting around 2011, going into 2014. I think, in particular, I think from memory, 2012 was challenging. I think for everyone. 13 was different for manager to manager, so to speak. But I don't know if that had anything to do with the downgrade. I have no idea.
No, I mean, it was just first in a number of events that kind of generated relatively choppy markets. So we had a downgrade in August of 2011. Equities fell, but then and then as you got into kind of the third quarter of 2011, you had greater strains coming from the European debt crisis. And then a recovery in equities in October of that year. So that would have been a reversal. And then, as you say, when we got into 2012, the expression risk on, risk off, we don't hear of it so much these days. But that was the real buzzword in that period, because you literally used to have different European meetings every month where where the debt crisis was solved and it wasn't, and markets kind of gyrated based on that. And market correlations were quite high. I remember at the time that was a challenge for trend followers as well. So you weren't seeing a lot of kind of unique themes and trends influencing the market. It all seemed to be this one risk on, risk off factor, which kind of went through 2012. And then obviously 2013, you had a taper tantrum. And as you say, it was kind of 2014 when we started to see sustained trends coming through. Obviously the dollar had a big move, bonds rallied, big sell-off in crude oil. So yeah, it was... I don't think you couldn't pin it on the debt downgrade, but it was the kind of one of the first events in that kind of 2 to 3 year period of choppiness in the markets.
Yeah, I mean, I think you make a great point about the correlation back then. I was looking at the return attributions for July. Obviously, I can only look at one firm for that number, but I did notice that actually it looks it looks like there's a lot of divergence going on. I mean, even within the same sector, you would have some markets doing pretty well in July and other markets just offsetting that. So there seems to be a lot of different things going on. But you know what, Alan? This wasn't necessarily, and this might surprise some people, I don't know if the two things we've talked about so far, unemployment numbers and the downgrade, was the biggest news this week. And I don't know if you have followed this particular part, but of course, the US Treasury Department announced that third quarter borrowing plan this week, which one of the money center bank described as a Treasury tsunami. They announced the numbers. And so approximately 254 billion of Treasury coupon notes were issued and bonds were issued in June. They said that this number will rise to 270 billion in August. It'll further rise to 281 billion in October. And based on the October numbers, we're going to be running at an annualized number of 3.37 trillion if the deficit doesn't rise any further. They also announced that they're going to do some kind of weird, maybe it's kind of a QE, but they're going to buy up older issues because bond traders have complained that the bid-offer spread on some of the old issues are way too wide in the bid-offer trade. So they're going to come in and just solve that problem for them, which again is another artificial impact on the markets, of course, not letting them just function as they should. But these are big numbers. And so you would think that bonds, knowing that those kind of amounts of new issuance are coming, that actually as what we saw initial sort of reaction on Wednesday, Thursday, that bonds were selling off. I mean, maybe rates for bonds should go higher for longer now because of all that new debt coming out.
Yeah, no, I think it's a fair point. I mean, this is kind of the flip side of the debt ceiling agreement. Obviously that was a risk in markets, but we got that resolved. But we knew that once that was resolved, what's called the TGA, the Treasury General Account, had to be kind of rebuilt because they had run down their cash basically at the Fed. So we knew that there was a lot of issuance coming. I mean, I haven't looked at it in detail. A big question was, was it going to be at the long end or the short end? Because they have been issuing more debt at the short end. But it makes sense, obviously. 10-year yields at 4.25%, T-bills 5.5%. Why wouldn't you issue more at the long end? But certainly, it again, it's part of the mix of factors which you would say should support higher yields. But it did seem to impact sentiment earlier in the week. But as I say, we've had a bit of a bounce yesterday. So I think it's certainly something to monitor, and it'll be interesting to see. It could be something that becomes more market moving over time. What's the appetite as they issue that debt? Because this ties into the view around is the dollar's reserve status under threat? Because if that was, and if international reserve managers were becoming less willing to hold dollars, you would start to see that in their the holdings of treasuries as well, which obviously we haven't seen to date. So I think that it's potentially a theme to watch going forward. And obviously a key factor in terms of driving bond yields.
You mentioned the word, it would make sense if they would issue more long bonds at this stage. But having said that, I mean, wouldn't it have made even more sense if they would have issued 50 or 100-year bonds like 3 years ago?
Yeah.
I mean, instead of 1 year or 2 year bonds, it's completely crazy. Now, another thing that's quite fun, I don't know if it's funny, but interesting, let's put it that way, is this what came out this week also? Maybe in support of bond yields, but of course Buffett came out saying, well, I'm buying $5 billion worth of treasury bonds today, and I might buy another later this week. And then Bill Ackman comes out and saying, well, I'm shorting US fixed income and I'm doing it in size. So again, it's not just the quote unquote experts or strategists that are divided on this topic. Even well-known hedge fund managers seems to have differing opinions, it would seem.
Yeah, I mean, and I think it's a matter of time frame as well. Obviously, you can make a case for that there's more upside on bond yields, but equally, and we'll talk a bit later on about asset allocation and how that fits in. But bonds are investable again, I guess. Where when they were at 0%, you had a big downside risk. Now you can pick up 5.5%, for 3 months or 1 year or whatever it is now. So certainly there is a case for kind of a if that's your risk kind of tolerance, if you want that type of investment.
Well, you talked about famous hedge fund managers having different opinions. Ray Dalio came out with a piece. I know we're going to talk a little bit about that. I haven't read it in detail myself, but I know you have. So tell us a little bit more. Yeah,
well, his piece was, he kind of left open a lot of questions in his piece, but it was, a lot of it was around, why has the economy stayed strong? And this is something we've been talking about, in terms of, obviously we had big fiscal transfers, the government issued debt and gave out checks during COVID. And that was, and we're still living through that in terms of excess savings and household balance sheets being in good shape. So it's kind of government, federal balance sheets being in poor shape, but household balance sheets being in good shape was a key part of it. One of the interesting parts of his piece that I thought was he touched on the fact that there's a debate underway among some of the central banks now about how they're going to deal with the losses from bonds. So this is a discussion for the Bundesbank at the moment, and there was, I think there was a leak from the Federal Debt Agency in Germany around whether they should go and recapitalize the Bundesbank in light of the kind of the losses on the bonds. Now, they're not insolvent or they don't have negative equity. They have big holdings of gold and foreign reserves. But, but they are going to have a negative cash flow. Obviously, what they're earning on their bonds is a lot less than what they're now paying on deposits. So it's kind of a negative cash flow. So we're going to see this around the world. There is this general question, does it matter? It came up when we spoke to Bill White last year. And, in theory, it doesn't. A central bank can just issue more cash, or, the government can issue debt and fund the central bank. So it's kind of the thing, it doesn't matter until it does, until it becomes a concern for investors. And it's kind of, again, a confidence thing. So I think it's something, a theme we'll hear more about as these losses accrue and that negative cash position continues. Again, it's not something that in itself is going to be significant. But if these kind of themes arise at a time of more debt issuance and maybe a general concern about kind of the trajectory of debt and deficits, it could be part of a whole kind of picture that causes concerns. So I think it's something an interesting topic to keep an eye on.
I agree. In fact, speaking of confidence, interestingly enough, we have a super interesting guest rejoining us in a few weeks, Peter Atwater, who just published a book on confidence, his second book, actually. And I remember from our first conversation, and this is kind of my underlying worry, if I have one. Well, maybe I have many, actually. But one of them is this thing about confidence, because I don't think we talk enough about it, but I don't think, and I don't think people realize how important it is, especially in financial markets. And I guess my underlying fear is that, at some point, and as you rightly say, it's either there or it's not. I mean, maybe we see a shift in confidence in some of these institutions who have steered us through many different crises, not necessarily in the most constructive way, and then at some point investors will wake up and say, well, hang on, we just don't want to do this one more time, and this will show up in market prices. Anyways, that's a little bit of a digression. Okay, so what else was in Dalio's piece? You talked about Japanification.
I mean, that's another theme that's been in the market in the last few weeks.
And China, I guess.
And China, exactly.
Yeah,
and
China,
Japanification in relation to China, and this has been something that I guess people have been worried about. I mean, people were worried about Japanification with respect to Europe for a while because of the demographic picture is similar. But I think with respect to China, it has come back on the radar in the last few weeks. And I suppose one thing that people are talking about is kind of a possible balance sheet recession in China. And there's the economist Richard Koo, who's at Nomura. He coined this expression, balance sheet recession, to kind of describe what Japan went through. So basically the idea being that when you have an asset bubble and then a downturn, people have a balance sheet, they're underwater on their balance sheet. So what happens then is companies go from maximizing profits being their objective to minimizing debt. So there's a huge kind of bias to run down debt levels, so consumption gets hit. And the fear is that this is what we're going to see in China, that we'll see structurally weaker growth over time, because obviously China is living with the fallout of a property market boom and bust, and then coupled with the demographic picture in Japan, which is obviously in China, which is similar to what we've seen in Japan.
Is this also what we had back in the late 1920s and 30s in the US?
Yeah, exactly. I mean, and that was the whole point about Richard Koo when he wrote his book. I suppose he challenged the kind of consensus explanation of the recession. I suppose the Bernanke kind of Milton Friedman view was a contraction of the money supply, which kind of turned an economic downturn into a depression. So the Richard Koo kind of perspective on it would be, well, that was part of the story, but equally, you had the kind of the asset deflation and the balance sheet impact, which is part of it too. And obviously we saw this, in the global financial crisis as well, that, people had negative equity on their houses and they were giving them back and then, basically walking away and then generally left with high debt levels. And what we saw then was a deleveraging. So it's kind of consistent with that. It is something we talked about with Louis Gave a few weeks ago. He was kind of a little bit dismissive of the parallel between Japan and China. His point was, well, the real estate bubble in China hasn't been anything of the order that we saw in Japan. Famously, people will remember that, that the land around the Emperor's Palace in Tokyo was valued as much as the state of California. So it was like a bubble of greater magnitude. So that's definitely a fair point. And obviously, Japan, China is a much more managed economy. The current account, capital account, the capital account isn't completely open, so they can manage things as well. And they seem to be able to, siphon off bad debts into asset management companies and just recapitalize. So you're not having a banking issue in China at the moment in the same way that we saw in Japan. But there was an interesting piece I saw from Paul Krugman then on this topic as well. And his view was, well, yeah, he was saying, well, will China go the way of Japan? He was saying, no, it might be even worse, was his view. largely because what you're seeing in China at the moment is actually very high unemployment, youth unemployment. So people aged 15 to 24, I think it's like 20% or so, maybe a little bit higher. So that obviously creates a big social challenge and a big, political challenge for the ruling Communist Party. So interesting to see how that plays out. And his point was, Japan, yes, has dealt with the overhang from the bubble. But actually, if you look at Japanese GDP growth, it has been sluggish. But on a GDP per capita basis, Japan's done actually fine over the last couple of decades. And it's a very cohesive society. The question is, will China be able to navigate its way through in the same way? So I think it's interesting. I mean, from our perspective, yeah, does it matter for markets or how does it matter? But I think one of the interesting themes is that we are seeing this kind of, solid growth in the US versus, this weakness in China. Obviously, there's been a lot of bullishness around commodities and it hasn't, things like copper, and it hasn't kicked in. And obviously kind of China has been a marginal buyer there. So that's certainly part of that story in relation to commodities. But equally, whereas maybe in the last decade, growth everywhere was kind of at the same level, now we're seeing more meaningful divergences in economic growth across regions. So in theory, that should offer opportunities, you would think, for trading and presumably for trend following as well.
Maybe orange juice is now the new barometer for economic activity. It's up 61% this year, while copper is completely flat. So anyways, let's jump over to trend following for a little bit, and then we'll dive into some of the other topics we have. I mean, trend following, of course, was a little bit under attack this week. Some of the trends that we've enjoyed in the past few months, like long equities and long Mexican peso, did suffer a bit from the US downgrade by Fitch or from some of the other things that came out, who knows. But you could argue that this is also part of a normal way markets trend, and they do well. It's never a straight line, and you're going to get these corrections along the way. I think it is way too early to say anything about whether we have seen the end of some of these trends. However, elsewhere in the trend following portfolio, of course, fixed income markets did enjoy some higher yields, and that's generally good, I would imagine, for trend followers around the world, although the party was caught a little bit short on Friday, as we already talked about. So we'll see how that pans out. Other than that, from what I've noticed, energies were okay, grains and meats did fine, especially meats actually. Then metals and soft were pretty neutral, and I think for the month so far of August, we started off on a little bit of a soft note. My trend barometer closed yesterday at 30. That is weak, and that should support some of the numbers we're seeing in the industry. As of Thursday night, down 57 basis points on the B-Top 50, down 59 basis points for the year. SocGen CTA index down about 1% for the month, down about 2% for the year. SocGen trend down about 1.4 for the month, down about 2.8 for the year. Short-term traders index hasn't really capitalized on these wobbles in the market, down a fraction in August, down 3.2% for the year. And of course, there were some losses in the equity markets so far this month, down 2.5% on the MSCI World, but still up 14.75% for the year. World Government Bond Index, not surprising, down 56 basis points so far this month, and the S&P 500 down 2.42%, but up 16.6% so far. Now, before we leave trend following completely, I wanted to just ask your thoughts about the fact that I noticed in the recent performance report that has come out for July, and I took a glance down to kind of the rolling 12 months returns for managers with more than $50 million under management. And I noticed that there were some dispersion, to say the least, between the best and the worst. The best up 73% in the last 12 months. That may be an outlier. I think that's fair to say. And the worst down about 40%. And there were a couple of those. But I think in fairness, it's worth mentioning that I think these are more pure commodity-focused programs. But still, there's a bit of dispersion going on between managers. Have you got any thoughts about, I mean, I'm sure you would have seen this many, many times during your time at Abbey, but anything you took away from that?
No, I mean, obviously it is a big feature of what we see in the managed futures is high dispersion, and you also tend to see low persistence in performance, in the sense that very often not always, but people who are at the top of the league table, one year will not be there the next year.
Which is interestingly enough, Alan, not the case this year. It's kind of
no, and I mean, you can't get that for very often. You'll see that a manager might be at the top for 1, 2, 3 years, and the problem is, from an investor's perspective, somebody could come to the space and say, well, who's the best manager? We'll allocate to this guy. Great 3 year, the last 3 years have been fantastic, and then just regression to the mean will end up the next 3 years. Doesn't mean they've got any better or worse as a manager. So certainly the magnitude of what you're talking is even greater than what I would have seen. I mean, I think you have to obviously adjust for volatility. So from memory, when looking at it previously, studies I've done at about 2021 vol, the dispersion used to be about 55 percentage points on average. Now I did look at it recently for the SocGen trend constituents, and I calculated at 15 vol, it was 26 percentage points, which is still meaningful, but not as high. So, but obviously that's for large managers that are all kind of similar. So I think once you start looking at a broader range of managers with some more commodity focused, you do tend to see. But I would say, I mean, a dispersion of 40, 50 percentage points wouldn't surprise me at all. I mean, it's obviously much greater. And then it does vary depending on the period. So often you get in a good period, you'll get even more dispersion. So I remember like in 2014, 2015, in that good period for trend, you saw even greater dispersion of where managers particularly capitalize on the opportunities. So it does vary depending on the market environment. And I guess at the moment, it doesn't surprise me to see a bit of dispersion this year. I mean, you've had the bond trade, now you've had the equity trade of late, you've had the currency moves have been quite linked to the equity move. But you've had kind of moves in commodities as well, the likes of cocoa, orange juice. So depending on whether you meaningfully allocate to those markets. So if you were a much more diversified manager and maybe a smaller manager and you can have more meaningful positions in those trends, you can see how you could have had that outperformance. So I think it is definitely something that people outside the space will be surprised with, particularly when you see that dispersion among managers that people would say are pretty similar. And I would say at the moment it's probably been driven by those sector allocations. Obviously, speed can be an important factor too, but I would guess it's the sector allocations that's the main driver.
I think that's very, very fair. And one thing I wanted to mention, I'm going to do it on a no names basis, but I think it will help people understand how these dispersions can appear. So, for example, last year there was a couple of managers that did really well. One of them, up close to 100%, 80, 90%, whatever. But when you look at the breakdown, from what I understand, 3 markets in that portfolio made more than 100%. So it's clearly, if you get your sizing absolutely spot on and you see a massive trend occurring, even just a few markets can make a big difference. While other managers who maybe not have done as well, but close to, would have had a much more, I wouldn't say evenly distributed attributions, but certainly not with 3 outliers like that. So it just goes to show that even though we are all trend followers and we all do things a little bit different, is what I meant to say, but they can show up as big differences year to year, without a doubt. Now, another thing, we're going to kind of leave the pure trend following aside now and jump into some of the articles and topics that you had found in particular interesting. And actually, this is something I didn't think of, but I think you're absolutely right, because we're talking about asset allocation. We're talking about, why you should include managed futures or trend following in your portfolio. And then the first sub point you listed was no more talk of end of 60-40 portfolio. And it's kind of right. I haven't really seen many articles about that recently, so I'm intrigued.
Well, that's just it. I mean, it's just been a remarkable change. I mean, every second article you read on asset allocation last year was about the end of the 60-40 portfolio. I just had a list there: Lombard, ODA, BlackRock, Goldman Sachs, KKR, Barron's. They all had this kind of, is the 60-40 dead, enhancing the traditional portfolio. And now into this year, absolutely zero talk about the end of 60-40, unsurprisingly. that it has come on the back of pretty good performance for the 60/40 portfolio over the last 3 quarters. So obviously kind of equities bottomed in kind of October of last year and have been rallying since, and bonds have been doing okay. I mean, in total returns terms, certainly positive. So whereas last year, I guess there was this very compelling case around diversification, and people, I think, tend to look at what's happening in the world and say, oh yeah, I see it. Look, there's a war going on in Ukraine, and the Feds, we've got higher inflation and all of this risk, and these strategies seem to be doing well. So it seems to be a fairly good case. Whereas you're into this year now, and it just strikes me that, and speaking to investors as well, probably a little bit more pushback on that idea. So people will say, well, fixed income looks interesting now. Bonds are interesting. And then, some people make the view, well, last year was a one-off. Like you came into your unusually low yields in bonds, and at low yields, your duration risk is higher. We had we've seen, 75 basis point hikes from the Fed, ECB. Nobody expected that. People say, well, will that be repeated? So there were certain factors there that you could say to, okay, it was an extreme year, and now you're into an environment of higher yields. So is there still that case? So I think it's a different case now. If you go back to 2019, 2020, when REIT yields were so low, it was easy to point out to people, okay, that's a risk in your portfolio, having that amount of fixed income, obviously from the duration perspective. So what I wanted to do was to take a look and say, well, okay, from a pure asset allocation perspective, what are reasonable kind of return expectations for the different asset classes? And then given that backdrop, what would be the case for allocating to trend following? So I suppose if you think about it, take equities first. So what's a reasonable return expectation? Well, one thing to do would be to take the obviously the price earnings ratio, and if you were taking a longer term perspective, you might take something like Robert Shiller's cyclically adjusted price earnings, so the CAPE. So that's at about 30.8 at the moment. So still very high according to history, not as high as it have been. So to get a return expectations, you take the inverse of that to get the earnings yield, and that's the real yield, and then add on your expectation from inflation, which you can get basically from kind of break evens. So that's at about 2.5%, which makes sense. The Fed's target is 2, but everybody kind of is of the view that it's going to be tough to get back to 2. So we'll probably be in an environment of 2.5%. So that gives you kind of a nominal equity return expectation of 5.7%. Fair enough. So then you look at bonds and you say, well, what's the expectation there? Well, obviously 10-year yields are about 4.1, 4.2. When I did it during the week, they were up to 4.2. They're back to 4.1. And actually, there's a very good fit. If you look at the starting yield for bonds versus the total return, you realize, which is what you expect, it pretty maps pretty well. So I think 4.2% would be a reasonable, that's a nominal expectation on bonds. So then you get, well, what's a reasonable expectation, say, for trend following? Most of the people we spoke to, I would say, on the CTA series said, well, the expected Sharpe should be somewhere about 0.5, 0.6, something like that. Now, actually, if you look at the SocGen trend since 2000, the Sharpe has only been 0.31, so it doesn't sound very great. But actually, if you think about that in the context of where we are at the moment with rates, interest rates are about 4%. Sorry, they're more than that. They're 5.5%, but the 10-year yields are 4%, 4.1. So that's telling you, okay, there's a bit of term premium in there too, but they're saying on average rates are going to be about 4% over the next 10 years. So I took a little bit off for the term premium and I said, okay, let's assume that rates are 3.8%. So you're going to earn, as a managed futures manager, you will earn that on your cash, but maybe not on the full amount. So assuming, say, you're earning that on 80%, combined with a 0.3 Sharpe, still gives you an expectation of about, 7.3% for trend following. So looks very reasonable. And then if you put that into an optimizer to say, well, okay, of those three assets, bonds, equities, trend, and okay, let's say the objective is to maximize the Sharpe, you could quibble with that or not, comes out with an allocation of 61% to trend, 28% to equities, 11% to bonds. So, okay, sounds like, why does nobody else allocate to this? So you might say, well, okay, what's wrong with this? Well, maybe we were too pessimistic on equities. CAPE of 30.8, people might say, well, that's backward looking, and maybe that's too pessimistic. So maybe go to the current PE, which is about 20. So that would give you a real earnings yield of 5% and add inflation to that. So your equities is up to 7.5%. So that does change your asset allocation. And so suddenly your asset allocation is now up to 38% equities, 13% bonds. But trend following is still up at 49%, 50% of the allocation. So you might say, well, okay, I'm skeptical on trend following. Let's knock in half the expected Sharpe down to, so I knocked it down to 0.15, reran the numbers, still with the adjusted, with the CAPE at, or with PE at 20. So then you're getting up to kind of 46% equities, 27% bonds, and 27% trend. So that's what, even if trend following is only half as good as it's been for the last 23 years, you still should be allocating about a quarter of your 3-asset portfolio. So I said, well, okay, say if you just think trend following will be marginally good, a 0.05 Sharpe. It came out with equities 54, bonds 40, and trend 8, which is actually probably what you would, people say, start off with a 60-40 portfolio and add a little bit to trend, 5 to 10%. So it's almost like investors are so skeptical on the benefit of trend following that they're actually marking down the expected performance by about, what's that, by about 80%, 85%, so, and even with that, there's still a case for having it in your portfolio because the positive returns, the negative correlation, and obviously, particularly in the current environment, returns look a lot better because you've got that boost from cash rates.
No, absolutely. I mean, obviously, I love these points, and I think that the point you make about even if you're incredibly conservative and pick numbers or returns for trend following that we haven't really seen, but we're just artificially keeping them low, you still have a meaningful allocation, and it's probably still higher than what most institutions have allocated at this stage. It reminds me of a couple of things that I've done on my side just to kind of try to visualize for people this. Well, first of all, people should just note that, yeah, you can get 5% on bonds right now, but actually the 10-year return on the MSCI, on the FTSE World Government Bond Index for the last 10 years is 0. You didn't get a return for 10 years. We've seen that, of course, in equities as well, from 2000 to 2012, no return on most equities. Even some equity markets in, I think, Southern Europe might still be below their 2000 peak, although they may be close now to getting to that. And so that prompted me two things, kind of similar studies to what you mentioned. I did a study saying, well, people often ask me about timing. Well, they asked me about two things. How much should I allocate? So you obviously come up with some ideas. And then the timing issue, right? And so I thought, well, why don't you combine those two and say, let's just try and optimize based on Sharpe between stocks, bonds, and trend following using extreme starting points. So I did before and after the tech bubble, because I think those are extreme starting points. Certainly when you put it into an asset allocation, your bond and equity portfolio allocation will change dramatically, but also before and after the great financial crisis. Of course, I used our own, Dunne's data, so I didn't do it on the SocGen CTA index. It's probably not markedly different. But in any event, the most consistent allocation between starting before and after a crisis with those two crises that I mentioned is trend following. It's really between bonds and equities you see the massive shifts. And I think actually right now you shouldn't have had any bonds in your portfolio, or very little bonds in your portfolio since the March of 2009, the end of the great financial crisis. So that's one thing. The other thing that I like to visualize from time to time for people who may not be familiar with it, because I think you're right in saying that a lot of people are incredibly skeptical and feel very uncertain about a larger allocation to trend following, thinking that it's a very unpredictable, not stable type return stream. But actually, when you look at rolling 10-year, let's look at rolling returns 1 year, 3 year, 5 year, 10 year. What you find is that with the exception of 1 year, there's a higher percentage of positive rolling 1 year returns when you look at the MSCI World Index and the FTSE World Government Bond Index. They do have a higher 1 year percentage of winning periods. But as soon as you get to 3 year and 5 years, it's pretty even, although I think trend following starts to do better. And when you get to 10 year, at least again using our data, we've never had a negative 10-year return, whilst even bonds have had negative 10-year return periods, one of them being very recently, and stocks have also had negative 10-year return. So I think it's a matter of educating, as you rightly say, giving people something to look at.
Yeah. I mean, I think the key thing at the moment is that equity valuation, because, obviously you can say bonds over the last 10 years, obviously, close to zero in some cases. Why? Well, obviously because the starting yield was close to zero. So that's why that's not unexpected. But the challenge at the moment, obviously, is that, and equity valuations, you can debate that, how high they are. But I suppose the key thing is that they are high relative to cash rates. And obviously, managed futures and trend following it's essentially a cash plus strategy, because you earn the cash and you have the trading profits as well. So I think at the moment, that's the key point, is that it looks particularly compelling now in light of where equities are and where rates are. So obviously, if we were in an environment where PEs were at 10 and interest rates were at 0, then if you ran the optimization, you'd get a much higher allocation to equities because your future equity expectations would be much higher. But we're not at that point now. So I mean, I think you're right. I think a lot of people, and when I talk to investors and people I work with, they'll say, well, here's my macro view. How does that translate into my allocation in alternatives? And that can be a difficult one, because you're always kind of trying to time what's going to happen over the next year. Whereas if you take a step back and just look at the valuations, you say, and the characteristics of the strategy, you can say, well, here's a very compelling case for this in the context of kind of what you might call your capital markets assumptions at the moment.
It's a good point. And the other thing about, the term return stacking has obviously had a lot of attention since Corey and Rodrigo and those great guys over at Resolve and Newfound have kind of made it popular again, reminded people that these things. But I think sometimes we forget, well, they of course are the first ones to admit that this is not new, this has been in existence for a long time. But I like the way they talk about it. But I think people forget, as you rightly point out, when it comes to bonds plus trend following, that's actually what you get more or less just buying a fund of a trend follower, because as you say, 80% of the money is probably placed in bonds or fixed income instruments to keep the cash safe. And then on top of that, you have the trend following return. So you don't really need to do anything other than just buy a well-run trend following fund, and you get those two benefits. Okay, let's move along, because you brought another very different topic along, something about Minsky moments, which we haven't had that many of recently, but they do occur, and maybe they'll occur soon again. Who knows?
Yeah, exactly. It was just, this is an interesting piece I saw from GMO and James Montier at GMO, who's quite a reasonable, well-known strategist, market commentator. And it's an interesting piece. I mean, Minsky moments, obviously, it's named after the economist Hyman Minsky. He had this framework of thinking about, periods of stability sow the seeds for instability, basically. And in periods of stability, people tend to take on more risk and more debt. And eventually you get to a tipping point, a Minsky moment, where sentiment changes and then people move into kind of the deleveraging, like we were talking about earlier, and that excessive leverage in the system is the cause of the crisis. So essentially, Minsky's work had kind of been out in the wilderness for a long time, but came back into focus during the financial crisis, because that was a very clear example of a Minsky moment. The fact that we'd had, that what economists call the great moderation, stable growth, low inflation, stable interest rates. That was fantastic. But what did it do? It encouraged people to take on more debt, and that credit grows and debt grows ultimately was the source of the financial crisis. So what this piece from James Montier is about is kind of slow burning Minsky moments, and his point is that there are signs of potential stress in the system when you look at debt levels, but it's evolving slowly. So that's why it's kind of a risk out there in the markets, but not currently evolving into a crisis. And he looks at debt levels across various economies, and he refers to another economist who kind of has a threshold of 150% of GDP as being a kind of a level for and this is across kind of total debt, so not just government debt, but looking at corporate debt, household debt, etc., and also looking at the growth rate of debt. So basically his conclusion is, yes, there are high debt levels, but the growth rate across a lot of the economies isn't above the threshold at the moment. So it's kind of saying, well, there's not sign of an imminent Minsky moment yet, but certainly from a kind of a structural balance sheet perspective, the high levels of debt are concerning. The interesting thing about the paper was kind of how to structure your portfolio in light of this. And I suppose the surprising thing was, there was no mention of trend following or managed futures, oddly enough, but it was all about the kind of strategies that you should use to kind of prepare for the worst. And they were cash. So I guess, as we've been talking about, managed futures and trend following being a cash plus strategy. So that's it. Obviously, he talks about, the pros and cons of options, volatility trading, and the bleed from that strategy. And obviously, that is, the returns to a long vol strategy. You'll get periodic bumps up, but it's a long bleed over time. And then more from an equity perspective, strategies with a negative correlation to that tail event. So basically, one strategy he had looked at historically is long quality stocks versus junk stocks. So I guess quality being companies with strong balance sheets, etc. And that historically has done well. But at the moment, the valuations for quality stocks are very high, because I guess a lot of the high-tech stocks would fall into that category. So the other strategy that he recommends is basically comes back to the old classic value versus growth as another way of protecting the portfolio. And that tends to do well in periods of significant downturns for equity markets. But yeah, what was interesting was the absence of any talk of trend following, because all of the arguments he makes around why this is why you need some kind of portfolio diversifier or why you need some protection strategy all apply, but they're all good justifications for why you would hold trend following in the portfolio. His way of addressing it in portfolios is these kind of equity tilts, obviously, value versus growth, and that sounds reasonable. And I know people who've used kind of quality as that kind of a strategy in their portfolios. But yeah, I think a good article if you want to make the case for trend following and managed futures, even if it's not mentioned.
Yeah, no, absolutely. And the article is called Slow Burn Minsky Moments and What to Do About Them. And I completely agree. When I read for example, in the executive summary, it talks about, having strategies that has a negative correlation or can have a negative correlation to the event itself, but also, is a great store of value and, long term makes money. And I'm thinking, yeah, that's, tick, tick, tick. That's what we do. And there's no mention of that. And it just goes to show, I think, that people are probably not as familiar with, this option, so to speak, as we would like them to be, despite our efforts every week to educate people. All right, let's jump again to another topic. I mean, one thing you could say that you can take away from the article, and it just follows that quote, and I can't remember who came up with it. I think actually it's could have been FDR during the Second World War, or before Second World War, something about we can't predict, but we can prepare. And I think that's exactly what investors forget to do most of the time, by including some of these strategies before the event, and then they jump into them after the event because suddenly they realize that they've been swimming naked, as Warren Buffett would say.
Well, on that point, there is another classic quote that he mentions, and it's that crises take a much longer in coming than you think, and then when they happen faster than you expect, and that's really, I suppose that's kind of the whole philosophy on this, is that, okay, there's risks and people are calling, oh, this is a problem, look at the high debt levels, and people just get comfortable. And then eventually at some point you get a change in sentiment and things unravel very quickly. And that's the kind of the philosophy of the piece.
And exactly, but it's also kind of a challenge for them, right? Because Jeremy Grantham at GMO, of course, has been out warning about these things for quite a while, and not only him, but many other people, and I think that shows the difference between what we do unemotionally and without any prediction, and what other people do. They may be right at some point, but it's just that it can be very costly to be wrong. And not to bang on too much about this, but I remember in the beginning of the year when trend followers began to go long equities, people were thinking or saying, that doesn't strike me as a very good idea. This is not going to be a year of great equity returns following what we saw last year. And look where we are right now. I mean, equities have done pretty well, actually, so far. Anyways, speaking of equities, I have a feeling maybe we're going to get to that. You had a conversation with Christopher Zook recently, and very, very interesting. From memory, there was also something about taking stakes in general partners in hedge funds. So, so tell me more.
Yeah, no, it's very, Christopher Zook is he's a founder and CIO of CAS Investments in Texas. His firm looks for thematic ideas to say, okay, this is the place to invest for the next number of years. They do like actually GP stakes in asset managers. So they think that's a very solid business. And actually, they're very focused on sports franchises at the moment. But what was interesting about that conversation, and it does relate to the slow burning Minsky moments discussion as well, is that couple of things. One, despite the fact that they're kind of longer term investors and quite focused on equity and equity type investing, he does see the risk reward in public equities as being particularly poor at the moment. So he has a kind of framework of rating the opportunity set from 1 to 5, and 5 being very attractive, 3 neutral, and 1 being very unattractive. And his view is it's a 1 at the moment, and largely due to what we've been talking about, because valuations are high relative to cash rates. So the prospective return on offer is in terms of the equity risk premium is low relative to the risk. So that was one interesting point, I thought. But a second factor that he touched on quite a bit was kind of the kind of coming wave of refinancing that we'll see, particularly in commercial real estate. But also, there's adjustable rate mortgages, and also more generally for corporates around the world. So if you think about it, we have had this ultra low rate environment, between 2016 to 2019. And what that did was it gave people the opportunity to borrow at exceptionally low rates or refinance. And some of that is on long-term rates, but in his what he was pointing to, that in many cases that these rates have to be reset or refinanced after 5 years. So to the extent that a lot of that borrowing was done 2019, 2020, that time frame, that as we move into next year, we're going to see a lot more pressure in terms of refinancing. And in some of those cases, particularly with respect to commercial real estate, the values have come down. So if you bought something for $100, say, or 100 million, whatever, and you put up kind of, say, 60 million and borrowed, or 50 million, you borrow the rest. Now, because the property value has come down 20-25%, you're going to have to go and find that cash to because the bank or the lenders won't give you as much, and obviously you'll be refinancing at a higher rate as well. So this is the kind of the idea of the slow burning Minsky moment. We know that there are risks out there from higher rates. People locked in very attractive rates, but they will have to be refinanced at some point. And it seems that kind of later this year, moving into next year, I looked at some data for US corporate maturities. There's 500 billion this year, 860 billion in 2025, 880 billion in 2026. And again, S&P and Fitch were making the same point about, like, a lot of companies will tend to kind of refinance maybe 18 months ahead of the actual maturity of those loans. So certainly, yes, we haven't seen the reaction to higher rates yet, but that's not to say that we're not going to see it. And one reason to expect that we will see it over time is this refinancing wave coming. You see it in the mortgage market in the UK as well. A lot of people on kind of fixed rate mortgages, maybe 1 to 2 years. That's fine. They can live at higher rates for the moment. But then as soon as you have to reset, I was watching the Channel 4 News the other night, and there was a guy who's facing repossession because his mortgage has gone from, I think it was 1% to 5.5%, or his monthly mortgage was like went from £1,000 to £4,000 overnight. So it's that kind of shift that's the type of idea that's behind the Minsky moment. So I thought that was very interesting in that conversation around this kind of refinancing risk that we'll see in markets in the coming 1 to 2 years.
I've never quite understood why not more countries adopt the way the Danish mortgage-backed securities market function. Because this really is a market that not only is one of the oldest, I think, in the world, but also for its size of the country is quite significant. And it used to be pretty liquid, I imagine. I don't know about now because a lot of bond markets aren't that liquid anymore, thanks to the central banks. But it's just the way it functions and just the way it allows people to lock in these 30-year rates at, obviously a couple of years ago, you could lock in 30-year fixed rates at 1% or even lower. And it just allows not only people to have certainty about the future, it also allows the young people, the first-time buyers, to get a chance to get into these markets. And of course, you can still choose a variable mortgage if you believe there's going to be a period of falling interest rates. But you can even convert these if rates go lower and the bonds that you've essentially borrowed goes above 100, you can always buy them back at 100. So you have no unlimited risk in that either. And of course, if yields go up as they have done, bond prices come down and you can buy them back at a lower rate and cut some of your debt out. It's just, anyways, going on a tantrum here. Anyways, let's finish off with something completely different, but just something that, a little article that caught my eye. There's never a lack of controversial comments when you read an article about Charlie Munger. And he is quoted of saying, Charlie Munger asked, do you want to be more like me or more like them? Why he believes diversification is an impossible and agonizing task any idiot can do. And Munger's core argument against diversification lies in the potential trade-off between safety and returns. While diversifying across multiple assets may help mitigate risk and protect against significant losses, it may also limit the upside potential for higher returns. Munger believes that investors who spread their capital thinly across numerous stocks may not fully capitalize on the exceptional growth of a select few. And of course, you and I had a conversation with Jerry very recently that kind of touches upon that, because he's going all in on diversifying on single stocks, while most managers in our industry just trade a handful or two of stock indices. And also it ties into the discussion we've had on the podcast many times about how many markets should you trade? And if you go for hundreds of markets, should it be developed markets? Should it be alternative markets? Now, just to set the stage, I'd love to hear your thoughts before we wrap up completely. But when I look at historical numbers, and you just go into one of these online databases where you can find CTA numbers, some of the managers, and okay, maybe they're not completely vol adjusted, all of these numbers, but some of the managers who've had the best returns for decades, frankly, are the ones who do not trade the most amount of markets. So maybe old Munger is right after all. I don't know. What do you think?
Well, it's interesting. I mean, I've seen Charlie Munger and Buffett not having very favorable things to say about managed futures before, so that they don't know everything.
Okay.
I would say
that is true.
And I think the point Charlie Munger also makes as well in that piece is, he says if you have loads of stocks, well, you can't keep tracking them all. You don't have enough capacity to monitor the earnings, etc. So I guess the difference, obviously, with respect to trend following is obviously that and managed futures is your insight is that markets trend, and you don't claim to know about what's going to drive corn or wheat or soybeans or copper or whatever at any point in time, but it's the belief that markets will trend. So, I mean, I think maybe the criticism doesn't apply to when you're applying a systematic strategy where you're not claiming to know everything about that market all the time. I do agree with you. Like, I mean, what we didn't focus enough on in the series was it's not just about the number of markets you trade, but how much do you meaningfully allocate to those markets? I think that can be one of the reasons why you can sometimes see managers trading 30 or 40 markets. But if you have a meaningful position in orange juice or cocoa or lean hogs or whatever it is, then that's going to give you a differentiated profile relative to managers who might trade it, but at a very small level.
I mean, this is sort of my observation over the past 3+ decades of this being in this industry, and that is that yes, we talk a lot about diversification. We kind of try to do it on many different levels, but when we really enjoy the best returns is when there is some, high degree of conviction in the portfolio, and that can be expressed in a few ways. Of course, nobody would have silly risk in one market, sure. But when we have conviction in, say, short bonds or long equities, et cetera, that's where we make a meaningful difference. What's interesting about that conversation, and again, maybe we need to thrash it out a little bit when we get a chance, and that is, I think people who, and this is my interpretation, of course, they may have a different point of view, but managers who choose to trade hundreds of markets. So one argument is to say, well, if I trade all these markets, there are more chances that I can find an outlier. That is true, but you're trading with such a small position that outlier is not going to make a huge difference. It'll make a difference, but it's not going to make a huge difference. And you also have more markets in your portfolio that can be in a range or consolidating, and therefore they can actually penalize you. We need to think about that as well. But the argument is that, well, I guess what you could say is we all, I think most trend followers believe that all markets have the same ability to trend. And that means that over time, they should deliver the same expected return. Now, this is a general statement, but I actually think a lot of people have that view from their research. So that means that the main benefit you get by trading a lot of markets, I imagine, is that you can smooth your return profile. You could probably limit maybe your drawdowns potentially, but you can certainly smooth your return profile. Now, that is going to show up in your Sharpe. And the funny part is that a lot of the people who say that they like trading more markets, et cetera, they also say that actually the Sharpe is not something they worry about too much. And anyway, we're going to have a bad Sharpe. So it is kind of interesting. You can certainly see it from many different angles. Let me put it that way.
Yeah, I mean, it's, obviously the point of it, yeah, trading lots of markets, in theory, you'll pick up on more different risk factors, and which makes sense. Obviously, you have to allocate meaningfully to them. But yeah, I think, but it sounds like this debate's going to rumble on.
No, I know. And you can't do both, Alan. That's the point, I guess. You can't trade hundreds of markets and also allocate, quote unquote, meaningfully, because you have to cut or limit your overall exposure.
I guess if you're only trading 10 markets, maybe at the moment you'd only be picking up on a reflation trade, like short bonds, long equities, and short dollar. Is it all in one trade, or are you picking up on lots of different things? Whereas obviously if you're trading, European gas, if you're trading emerging market currencies, you can be picking up on, obviously you talked about Mexican peso, that's benefiting probably from the nearshoring trend. So that is a different factor to maybe the global growth factor. So you can see intuitively why that's the logic for it.
It is also touching a little bit into this point about that, some managers will say hundreds of markets, even better, alternative markets. Some managers will say, 50, 60 markets will do fine. And then we have the replicators who say, well, you can replicate the whole thing using two handfuls of markets, whatever. So I understand why people might be confused about this point. We're going to leave them a little bit confused because we have to wrap up our conversation. But if you enjoy them, why not leave a rating and review? Because it is something that really does help the podcast to be noticed by more people. Of course, you should do that on your favorite podcast player in any event. Questions for us should be sent to info@toptradersunplugged.com. And next week, I'm joined by Mark. So make sure you do send in some questions for him. These are always fun and insightful conversations. And we'll do our best to answer them as well. By the way, I used to talk, I don't know if you know the answer to this, Alan. I used to talk about people, things we pick up on Twitter. But Twitter has changed its name. So I don't know what to call it. Is it a tweet? It's not a tweet anymore. Is
it an X? And I'm not sure.
I don't know. Anyway, maybe someone can help me out here. All right. From Alan and me, Thanks so much for listening. We look forward to being back with you next week. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.